Hello, welcome to the Market Cover. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you, as always, for giving us a few minutes of your time here where we're going to go over some of the things that we found important and worthy of sharing with you from our weekly investment allocation meeting that we hold each and every Monday. So we're going to talk about the Fed and Fed cutting rates and what types of stocks tend to do well. And then Andrew's going to cover a couple of election year cycle themes for stocks. So we'll start right in with the Federal Reserve rate cut and hike cycle, and overlaid with a ratio here of what we call quality growth stocks versus lower quality cyclical. So this comes from Morgan Stanley. And first of all, the gold line, that is the Federal Reserve interest rate that they control, the Fed funds rate. You can see how it declines over time and then it will spike. And if you go to the far right, you'll see this recent era where interest rates have spiked, but perhaps are turning down. And I should say this is not actually the federal funds rate, but this is a one-year treasury yield, which would be closely tied to the Fed funds rate, just for the detail sticklers out there, which I know you have several that would certainly bother me seeing that. So anyhow, we're looking at one-year treasury rates. And then the blue is looking at a ratio of quality growth stock versus lower quality cyclicals. And as it turns out through history, when rates are going down, that is an area where quality growth tends to outperform. Investors are typically looking for companies that have an established and dominant moat. They are profitable through multiple cycles and not as dependent on having a strong economy like you'll often find in the cyclicals, which kind of need to have an above average GDP growth that can drive up revenue and turn a profit, unlike their quality growth counterpart, which tend to be more smooth and can again, profit through multiple environments. So this is just one thing that we have to look at. Different types of stocks do different when rates are going up or going down. And very clearly, if we don't know exactly what will happen, but the expectation here is very strong that we will have rate cuts this year. So that's on the Federal Reserve side. And I know just over the years, something that we have said many, many times to you all, and I just can't say it enough. And just from sitting in my seat as wearing my advisor hat, there's been few things that separate people from their financial aspirations as politics, whether it's because it's an emotional topic or it's tough for us to see the world going differently than we would expect for whatever reason. And I've seen that from people on the right. I've seen that from people on the left. And so as we go through these seasons, it's an easy way for people to become separated. So I really appreciate taking a look at data and looking at history. And that's what Andrew's going to give you the spirit of, starting with election year cycles.
Thank you, Adam. That's an excellent point. A lot of emotions come into election years. And if you've been a longtime viewer, a longtime family that we've worked with, you know we try to set emotions aside as much as humanly possible, really trying to stick to the data and the history and the things that we can really put analysis to. And so while it probably won't be the last time we talk about the election cycle or the election in general, once as we move into 2024, look at historically what the stock market does when we go into the fourth year of the presidential cycle. Now, the big caveat here is just because this is what history has shown in the past, of course, does not mean it's what will happen this year as well, but it gives us a good roadmap of how typically these cycles work. And we traditionally do see the market follow these presidential cycles pretty well. It was something we talked a lot about in 2023. If you were watching back in August, we typically saw third year presidential cycles start to peak, and they typically bottom around October. That's exactly what we saw happen in the market last year. So we always don't see the market follow lockstep with presidential cycles, but it's good to know what those analog, what history is telling us. And so the first chart I want to share with you is when we've had a really strong third year presidential cycle, like we had last year, where the market's up over 20%. This is looking at just price only. So price only, not looking at dividends or anything like that. The market was up about 24% in 2023. Typically, strong years in year three have led to very positive years in year four as we're moving into 2024. You can see the data there that the maximum year has been 27, almost 28%, and there actually haven't been any negative year four presidential years when we've had a really strong year three. So, of course, again, big caveat, that doesn't necessarily mean we can't have a down year in 2024, but historically, the strength from the prior year has often carried forward into the next year. Now, that also starts to ignore some of the intra-year volatility. A great example of that that's been very recent is we can see on this chart 2019, 30-year presidential year was positive, up almost 29%. Coming into 2020, and right off the bat, what did we have? We had the COVID crash. We had the market, a huge market event, huge global event, as COVID spread, covered the entire basically global economy shut down for a period of time. Market crashed in March. Thankfully, had a big recovery as a lot of the government agencies started to really kind of flood the market with cash, and we had the repercussions of that. But we saw a lot of volatility during that period. It wasn't just a matter of closing our eyes on January 1st and seeing where the market was at the end of December. Thankfully, we did end up having a positive year. The market rallied about 16% in 2022 or in 2020. And so while we can see here these are annual returns, it still doesn't mean we can't see some intra-year volatility and something we have to be aware of. Now we're going to get a little bit more granular. We're going to look at kind of the path the market takes, and that's going to be our next slide, looking at election years. And so we have a couple different lines here. I'll try to unpack it the best I can. The blue dotted line is when we're in a presidential year for a first-term president. Biden, this is his first term, and so that would fit kind of the scenario we're in today. And then you have the orange line, that's all presidential cycle years, regardless of term. And then the red line is the current path we're on right now. So what this is showing is the full 4-year presidential cycle. And so the red line, you can see we've gone through 3 years, and now we can look at what historically happens in the 4th year. What this is telling us is typically we start seeing the market maybe consolidate, digest those strong gains we had in year 3. And traditionally, the big returns, the bulk of the year returns come in the back half. You can see where that orange line and the dotted blue line start to kind of stagnate at the beginning, and then towards the summer, going into year end, is when the returns start, when the market starts to really pick up. So what that tells us is if we do start seeing the market consolidate some of these gains, start to maybe have a little bit of a pullback, then that's very normal market action for this year of the presidential cycle. Again, it doesn't mean we have to follow that, but it gives us a baseline, a foundation for tracking the price activity, looking at these cycles. And as you can see, it's done a pretty good track. So for the last 3 years, have done a pretty good job tracking that presidential cycle, having the decline in year 1 and 2, and then the strong year in 3, in 3. And now we can see if we continue to track it in year 4. So again, this is kind of how we approach the election. We're not concerned with polls. We're not concerned with who's leading in what state and what have you. We let the pundits unbox those topics. We're really focused on the data, focused on market history. What are the companies doing? Where are we seeing growth and opportunity? And have that be what drives our portfolio decisions. So this is just one glance, one way we do look at the election from a very pragmatic, data-focused approach.
Yeah, thank you, Andrew. And I just couldn't help while you were covering that. I can go back about 20 years. 2002 was my first full-time year in the industry. I had some intern years with FEG before then, and obviously a student in the markets before that academically. But I can remember 2003, 4, that kind of being the first really glimpse of the time I was seeing presidential cycle data and thinking, well, by golly, this is only 4 or 5 decades. This can't be too long of data. And ever since then, I can just say it's just interesting to see it have been a useful guide. And it hasn't followed that every time, but over time, it has proved to be a useful guide and worthwhile and paying attention to, especially, as I said, where this is the easiest way for investor to be separated from their money is in the election cycle. So we do appreciate you giving us your time here. And as always, we'll give you a reminder, if we can be of service, give us a call, 800-928-4001, or scan the QR code and book it electronically. Thanks again and have a great weekend.